Welcome back to B Grade Economics. This is Nate. Let's get started. So today is the 4th of January, 2022. We are doing a Tuesday review of stocks and assets and how they're performing. This is your weekly update, and so far we're going to start with the government bonds. And the reason why is because this has been one heck of a killer in the market, kind of showing us a trend here on currency assets. We're seeing a huge uptrend beginning. And we've seen this before where it kind of goes up, tapers off, comes back down, and then chops up. You get large candles, large green candles that get you started on these movements. But the Federal Reserve and the United States government are going to have a hard time servicing debt over 1.85%. So I've zoned out this area of where they're going to look to reject the bond yields here, because if it goes towards 2%, the market's going to get real nervous. So I would just be cautious and pay attention to this, but higher bond yields in an inflation-based environment can yield you good returns on monetary assets, and that's what we want to watch for. The U.S. 10-year, the Federal Reserve balance sheet, and the federal funds rate, blue, black, and green. This is the U.S. 10-year clearly on a decline, and this is the thing that I think people get confused, is that they think that that QE, the increasing of the Fed's balance sheet by asset swaps, is going to cause the yield curve control, which it has caused a lower bond yield over time. But I want to be clear here that once they initiated QE in 2008, once the market took hold of it by 2009, an uptrend in QE typically leads to a little bit of an uptrend in bond yields, right? So when you get these surges, you get an upsurge in bond yields, and when you get these downturns, you can get, or a flattening, you can get a downtrend in bond yields. Now, here's the divergence that I want to talk about and what I think the Fed is trying to do. They're going to try to taper, and that's going to cause a little bit of disruption in the bond yields, because the bond yields will drop because the market thinks that the stock market's going to crash, right? This is the inversion that people think is going to happen. The automatic assumption is that if QE ends, then there's not a big buyer left in the market for bonds, and so the bond yield will rise. But that's a false equivalency for what is actually happening. The buyer of the bonds, the Fed, is getting out of the market, and that is why the stock market has gone on a rally. And so bond yields rise when the Fed buys bonds, because they are basically absorbing this asset, eating up opportunity, and so people sell their bonds to go out and take more risks, and they borrow money into a looser lending environment. What the Fed is probably going to do is they're probably going to try to taper, just like they did 2015, 2017, 2018, that range. They're going to try to taper. It's going to cause a disruption in the bond market. They're going to try to raise rates, and that's going to be what they think is going to stabilize the bond market. But the problem is what happened in here in 2018. Taper tantrum. The stock market turned to crap. And so I think that's going to play out at a much faster rate here in 2022, and you're going to get a taper tantrum again. And people are going to sell their stocks to buy bonds, dropping the yield. The yield curve is going to go up. They're going to try to support the yield, but the thing is the yield, the federal funds rate going up does not guarantee that the bond yield goes up. It does have a tight correlation here in a lot of cases, but it doesn't guarantee that, because there's a free market occurring here, and this is set by the Fed, and even this, the banks have to agree on and actually execute. So you're going to see the market play games with this, and it's not going to be in the favor of the Federal Reserve, okay? The US dollar currency index, the DXY, I don't take too seriously, but it's the dollar compared to other currencies. What I want to take from this is whether or not there are inflows to dollar and dollar-denominated assets like bonds. And so to me, this uptrend signals that most foreign currencies are doing worse than ours. And since bonds are rising, bond yields are rising, what you're getting is more interest in our stock market. And so foreign investors are looking at the US stock market. Now, if they get scared, they're going to get out, and they're going to get out of bonds, and then the US is going to get into its own bonds, and you'll get this downtrend. I think you're probably going to see a little bit of a correction in the DXY no matter what, as it's had this long uptrend, and it's going to have a hard time spiking unless enough chaos ensues that you get a liquidity crisis like back here in 2020. Now, I don't think there's as big of a liquidity crisis brewing here as much as there is just a massive deleveraging that has to occur that can lead to still a deflationary spike. The S&P 500 so far has been on its overall large channel, and there's nothing to be concerned about just yet. We do have a divergence where there's a descending RSI, a breakout above. We have a flat price and then a breakout above, and I just don't think there's enough gas in the tank to get this thing rolling right now. So we're kind of just watching and waiting. But if you look back here in September 2020, you can see that there was a spike, a drop, rise, drop, rise, chop, and then we got back into it, right? So that could occur here. But again, you're kind of waiting on what is going to happen with the Federal Reserve, because we're still creating this environment of fear because of nervousness in pricing and how badly does this affect markets in real life. So then I get to the NASDAQ and I notice that there is Wychoff Distribution occurring. Now, Wychoff Distribution is very much dependent on phase C and D and volume increasing to the selling side on distribution. So right now, we have confirmation of most information for the Wychoff distribution. We are in phase B. I can't guarantee that it stays here. This is just a buildup for a framework, and when I learned how to use this, it was like a hammer and nail. I used it on everything, and I realized, like, no, it's really all dependent on phase C and phase D. I can get the setup, but it doesn't mean anything until I get the phase C and phase D. So from a trader's perspective, you're not executing till phase C and phase D. From an investor's perspective, you might be buying the dips and then hedging on the pips here until you see either a break above or you're going to reduce some of your spot position as you see it fall below. So just things to think about. But I'm going to get into how I think that this is starting to line up with a few events. So if you look here, based off this current trend, we're heading into like February, March, which would be when the Fed would end its taper and be increasing its federal funds rate. The price targets here from the point and figure are going to show me 15% and 23% downsides. That's pretty significant. Now, when we go through testing, just to confirm, upside objective accomplished from the price and point and figure chart. I use this from the last time it formed a crown. Point and figure chart targets achieved, accomplished. It only needed to go up to the top here. We've gone a little higher. The activity is bearish with the volume decreasing on rallies and increasing on reactions. Yes. Preliminary supply, buying climax bar, and point and figure chart. So I showed you on the previous one that we have the PSY, the BC, the AR, the ST, right? I can't see it on this point and figure, but if I were to draw out the point and figure allocations, it would be forming a crown regardless. The stock is weaker than the market. So this one's a little bit of a discussion because it's already a major index. So the only thing to compare it to is the S&P 500. And as I showed you, the S&P is a little above the top line versus the NASDAQ is below. So I'm going to call it weaker. But on top of that, it's more responsive to the market on reactions and sluggish on rallies. Think about the breadth going on here. The smaller caps are absolutely, like, they're down to like 52-week lows right now, while the big caps are still holding it all up. This, to me, breeds a weak market for the NASDAQ. So these are things to watch. The upward stride broken, that was the line that was there for showing this uptrend, and then we broke it when we went through the BC. I forgot what it was called, but we go through the buying climax, and when we broke that, we broke the uptrend, right? Lower highs bar and point and figure chart. So lower highs, we had a lower highs starting. Can't guarantee that if we have this up thrust, but we do have lower lows for sure, right? And then the lower lows point and figure, I don't have it on the point and figure, but I do have it on the bar. It just doesn't show the last couple weeks. Lower lows, and then crown forming for the lateral movement. If you have these here, it would be a crown right now. You can see that the crown's forming here. That's this box with the chop here looking like the top of a crown. And then the estimated downside profit potential is at least 3 times the risk for the initial stop order. If you were going to execute at this sign of weakness, yes, it would be a 10% or a 15% drop, or sorry, a 10% drop with a 3% upside risk. So yes. So overall, we are on track, and the only thing here to tell you whether or not we're going to fail is whether or not there's going to be a selling increase here into phase E, and you're going to want to see the volume spike into the selling and decline on the next rally we're going to see. So we should see a weak rally. Going into gold, We're still in kind of this accumulation chop. I still stand by that we're approximately here in the historic analysis of how monetary hedge assets respond to an inflationary market. And so with gold, I'm expecting it to continue to perform reasonably well. But if we get this deflationary event occurring in the NASDAQ and possibly in the S&P, and you get all this chaos, we may see a downside as it falls with the rest of the leverage in the market. If you look at silver, this one I've been tracking this Wychoff accumulation for a while. Now this is a really clean chart. All I did was just show my projections, show where it fit, and I'm noticing that it fits pretty closely into the dip phase or the spring in phase C into March, right? Now I could drag and draw these lines around, give myself more time, less time, whatever, got it. But the setup between these assets is starting to show me that we are kind of moving towards an idea where we're going to end up seeing a sell-off, where we're going to end up seeing market weakness. And then we go back, history tells us that inflationary response is a sell-off in metals, a buy-up in stocks, bonds begin to rise in price again, and then you see the inversion or reversion of this activity once the crash begins, once you get that plunge, right? So I'm just saying, history says this happens. It doesn't have to happen in March. It doesn't have to happen in January or February or April. It doesn't have to happen in 2022, but history tells us this is what happens. And I'm seeing trends that are going in a pattern where they could fit together in a reasonable way. Now, that said, I'm still generally bullish on tech continuing to perform in 2022 for a bit. I know that may sound a little weird from all the perspective that I tend to provide, but right now I'm just seeing that there is a trend of the tech stocks not necessarily being done, but they do seem to want to have that stimulus. And I think that we're going to watch a little bit of chaos ensue. And it doesn't necessarily mean that we go straight to reversion of these activities, pricings. So finally on Bitcoin, we had these accumulation zones, and I did a video on these modified Wychoff accumulation phases where you see the volume increase into the sell-offs and then buying increase finally near the end. And as I said, in phase C and phase D is where it really picks up. This being phase C, this being phase D, same thing. So it's this last little hump here is where it transitions. And that's the thing we're at right now. And this one's making me more nervous than these last two. These last two were easy for me. I was pretty confident. Like once we got down here, I was like, no, I'm seeing a change in the market. Now, here's the thing. Every single on-chain metric, every single bit of information except volume, except like, gambler attention basically, is up. So the only thing that's going to hurt us here is simply there's just not enough buyers, which is 100% a reason for a market to tumble, right? So I would say the low volume is leading to low liquidity, and this is my general trend line zones for concern, is if we're not maintaining this uptrend, I'm going to get a little worried. But going sideways isn't the end of the world. But very quickly going to get more concerned as we start to fall off. So right now, what I've done previously, and I'll show you my lines, when I did these before, I added leverage on the way down into the phase E as the phase E started to go off. And then I rode that up, and then when we broke the first trend line, I sold some of my leverage, rode that up, sold some leverage, got sideways, it came back down, I added it again, and I just rinse, recycle, repeat. So at this point, at around 45K, I have added leverage, right? Like throughout here, I've been like, well, this has worked before, I'll take the same trend. Now, I'm not counting my chickens before they hatch. I will be adding short positions here and removing my leverage if I don't see this play out with the volume the way that I expect it to. And right now we're seeing an increase in the selling pressure and not a lot of results for the effort on the buying pressure. And so I want to see this transition. I want to see the sell-off. Maybe we get a liquidation event, but the volume drop in that, and then the volume really rise into a buy, right? We should see it get somewhere up into here or even here where the volume just picks up and we get some really strong candles to the upside. If we don't at least see it get above this line and then start building volume, even if we get up here, I'm concerned because I've seen evidence in other markets like the S&P showing me that when that happens, sometimes that's the end of the day, right? So downside targets, being realistic, Somewhere in the 33, 36 range would be the bottom end range that I'd be looking at right now. The liquidation events or other major risks, you're still looking at like 42K. We're not done completely just because we fall below these lines. Holding spot position is a strong position. Adding leverage once you get that confirmation is where you might feel a little more confident. I might be a little early being too soon, but so far I don't see the evidence to tell me why not yet, other than I'm just not seeing the extra evidence to be bullish. So I'm neutral right now in my viewpoint. I am bullish on my leverage, but it's simply because I had an opportunity to buy it low, and I'll wait and see what happens. So that'll conclude today. Thanks for watching. I hope to see you all again. Good luck out there, and see you next time.